I'd like to welcome all those logging on to Money Show's virtual expo. We do have about 3 minutes before the next session. Thank you so much for being here. Sit back. We'll be right back with you momentarily. All right, David, we are just about ready to start here. Lead us off with a quick intro, and we'll be good to go. And welcome, everyone. We are pleased to welcome David Towell, co-founder and president of ProChain Capital. ProChain Capital is a multi-strategy crypto asset fund. This fund has been operating since 2017, and the principals have deep experience in crypto assets, token mining, venture capital programming, and asset management. David has managed hedge funds for more than 15 years and has previous professional experience in the areas of corporate restructuring and bankruptcy. He is a frequent contributor to the Wall Street Journal, Financial Times, Bloomberg, New York Times, Reuters, CNBC, and Fox Business. David earned a JD degree from the University of Michigan Law School and a BS degree in business management, graduating magna cum laude from Yeshiva University. David, thank you so much for joining us today. It's all yours.
Thank you so much. Thank you for the introduction, and thank you to the Money Show staff for inviting me today. I'm pleased to go ahead and share with you an introduction to investing in cryptocurrency, understanding the digital asset revolution. Certainly, there will be much more deep and finer points to be explored as a result of this presentation, but I want to go ahead and lay some groundwork for those that aren't familiar with digital assets, have heard a lot about different types of cryptocurrencies, and give an understanding about why, at least we think over at ProChain Capital, that this really is a revolution and has a very long tenor. After getting through some disclaimers and my biography, which has already been mentioned, this is what we will go through this afternoon in terms of topics, and I will hit on each one, hopefully in turn. So look, why digital assets matter. First of all, at this point in time, if I'd been giving this lecture or talk a couple of years ago, we wouldn't be talking about a lot of these matters in the way and in the advanced state that we will now. And that's really helpful in terms of reducing the risk that exists around digital assets and giving much more comfort towards the upside valuation that exists. So firstly, institutional adoption. Once was the case that institutions, everything from traditional money center banks all the way to broker dealers, had differing opinions on digital assets at this point. Whether the CEO or the spokesperson of any particular institution wants to support digital assets or not, what is the case is that every single financial institution out there does either trade or suggest to their investors to trade or provide investment options to its clients to be involved in digital assets. In addition, many institutions have bought digital assets for their own balance sheets, for their own holdings to diversify their own asset base. And it is becoming more and more prevalent for digital assets to be used in many different types of activities, including transactional activities and moving value. The second element is regulation, especially here in the United States, but certainly all around the world. As time has gone on, regulatory bodies of varying kinds, whether they be securities, money related, money laundering related risk, have developed frameworks to regulate the industry. Regulators have become more comfortable with the asset class and have resigned themselves to the fact that it is certainly here that is something, it is certainly something that is here to stay. Third, tokenization expanding, and I'll talk about this a little bit more on the next slide as well. But the tokenization or digitization of assets is really what this is all about. In some cases, the asset that we're talking about is strictly value, like the value in a dollar or the value in an ounce of gold or the value that exists in a share of stock or a bond or other things like the title to my automobile or a home. Tokenization of all of these assets is increasing. Sometimes tokenization will be the only representative form of the asset. In the case of many assets that have been fully digitized, no one owns a share of stock any longer, right? They're just ledger entries on your broker-dealer's books, and there is some record being kept about who owns what shares and how many and what price they paid and when they bought them. But that being said, journal entries about many things, like our bank accounts even, have been digitized. And more, we will see not only the digitization in the sense of ledgers that are kept internally, but tokenization on open source public platforms. And that's really what is going on with respect to the tokenization that I am speaking about, that the cryptocurrency industry is focused upon. And so even when there is a physical asset like a home or a car, nevertheless, the registration, the ownership, and so forth, tokenization is happening all across the spectrum. Finally, integration with traditional finance. I think this is the most important hurdle to clear. Traditional finance folks realize that a lot of what they do can be made more efficient, cost less, more secure by using public blockchains. And so the takeaway, and if you didn't understand all the language that I used, don't worry, I will go over some of these terms in forthcoming slides so it'll begin to resonate a bit further. But the takeaway is that digital assets at this point are a recognized asset class. Moving on to value, which I think is one of the easiest for everybody to conceptualize because we all transfer value all the time. We may have started out with valuable pieces of material or valuable holdings that people had, physical holdings. Those were then represented by paper currency. We had the gold standard, and we went off of the gold standard in terms of what was backing that paper. Then came electronic banking, which is what we all use certainly today. There is much more movement of value in electronic form than in physical form at this point in the world. We also have internet payments. And then when it comes to moving money or moving value, rather than having an internal journal entry that is kept securely, hopefully, by a particular organization like your bank or your brokerage, There is a way to distribute this so that it is a transparent, immutable system publicly. That would be Bitcoin, which is where the digital asset revolution began. And then from Bitcoin, we move on to tokenized assets, tokenizing or digitizing other assets beyond value, beyond just the value of, let's say, a dollar, or a yen or a pound. You kind of get the idea. Now we'll digitize shareholdings, bonds, property value, even binary contracts that we may have, having nothing to do with finance, like a life insurance policy. So let's get down to the fundamentals of the blockchain itself. What is this blockchain? Well, it is a ledger that is not kept by any particular institution. It is distributed. It is out for public view at all times, full transparency. It relies, to skip to the third bullet point on this page, it relies on decentralized validation. So unlike a privately held ledger that would be up to a particular company to keep safe and keep updating, a distributed or decentralized validation mechanism requires other outside parties who have a financial interest in validating the ledger to participate. And the further distribution that occurs, the more secure the ledger becomes. Because if there needs to be a consensus amongst hundreds versus amongst thousands versus amongst millions of those validators, then because it is much more spread out, reaching a consensus is much harder, and therefore it is much less likely to be undermined by any bad actor. And so we reach the point where the decentralization is critical to keeping the ledger secure. To go to the second point, it's transparent and it is immutable. You can't go back in time and undo anything that has already been recorded and agreed to. And there is secure transaction settlement. Now, there are two types of validation activities. There is what is called proof of work, which is essentially boils down to computing power and therefore electricity in most cases, versus a proof of stake validator. The former, the proof of work, where electricity and computing power is what allows miners, or what they call those validators, they need to operate certain high frequency functions with compute, and they are financially rewarded for that, therefore incentivizing them to continue to support the validation mechanism. However, in the case of a proof of stake like Ethereum and most other cryptocurrencies, the validators stake their cryptocurrency to secure the network. And so proof of work emphasizes computational security, and proof of stake emphasizes economic security. As an aside, obviously, when we talk about power usage, there are certainly a slew of arguments why proof of work or mining is less, let's call it, environmentally conscious versus a proof of stake, and that's always been a rub between the two. But nevertheless, these are two different mechanisms that are used. Again, proof of work largely associated with Bitcoin, proof of stake largely associated with other cryptocurrencies. So let's talk a little bit about the digital asset ecosystem so that you folks as listeners and investors and traders can understand what the scope of investments are inside of this universe. So as I mentioned, Excuse me, folks. Sorry about that. As I mentioned, so
Oh, sorry,
Bitcoin,
David.
yeah,
The
oh,
presenter two icons.
got
There
it.
you go.
Sorry. So uh, Bitcoin is the father of all cryptocurrencies, simply used as a mechanism for storing value. You will find folks that will say Bitcoin one day will be a means of spending. I don't think that that is going to be the case long term for a bunch of reasons that we don't need to go into. But I think Bitcoin is the primary store of value in the crypto ecosystem. Um, Altcoins, or the moniker used broadly, includes things like Ethereum, Solana, BNB, and there's a whole host of others that I'll get into, kind of putting them into silos in a little bit in terms of their functionality. But those are other types of cryptocurrencies, and I'll explain what they do in a little bit. Stable coins are simply crypto dollars. And they get transmitted on many types of networks. There are many forms of stable coins. The largest ones that you may have heard of are Tether, UST, or USDC, which is Circle's stablecoin. There are others in the works. There are others that are being used, but nevertheless, they are very simply just spending mechanisms. And most folks believe, with the upcoming legislation that is expected to be passed sometime soon, hopefully, and I'll get to that in a little bit as well, called the Clarity Act, that stablecoins will become ubiquitous. Folks will be not only asked, but maybe forced to use stablecoins because they are faster, cheaper, and more secure than the digital dollars that we currently use, like Zelle or PayPal. Tokenized financial assets, you will see these more and more, where stocks, as I mentioned, and bonds will be tokenized. And I should pause here for a second. Tokenization of stocks and bonds may sound like something that is a little bit out there for those of us that have been involved in financial assets for a long time. Under the current presidential administration, along with the head of the SEC and the head of the Treasury, all are supportive of digitizing financial assets, and they are looking to do it within the confines of this presidential administration. So if you think that this is something far off, I have another truth to go ahead and tell you. This is something that is going to happen rapidly over the next just couple of years and has already started. Effectively, it won't be any different for the user in terms of experience. It may be faster, it may be a little cheaper, but inside of the guts of brokerage houses, inside the guts of exchanges of varying kinds, stock exchanges, commodities exchanges, and so forth, things will change a lot. The next is ETFs. So as you know, there are ETFs of all different shapes and sizes. Most of them are focused on baskets of securities, but there are single stock ETFs, the same way there are single stock cryptocurrencies. And so, for instance, IBIT, is BlackRock's Bitcoin ETF. And so instead of owning Bitcoin outright through some either exchange or in a cold storage, you can own the ETF and get the financial benefit. We'll talk about the risks and benefits in a bit. And then treasury companies. There are companies, actual corporate entities, that made it their mission to raise capital and buy some type of cryptocurrency. The most well-known is Strategy, or used to be known as MicroStrategy, run by a gentleman by the name of Michael Saylor, ticker MSTR. So let's go to stable coins and tokenization. What stable coins allow for are efficient payment mechanisms. And as I mentioned, we're waiting on the passage of the Clarity Act in order to unleash the stablecoin revolution. The Clarity Act doesn't directly address stable coins. Stable coins were actually addressed by a previous act that has now been put into law called the Genius Act. But there are still some outlying issues relating to stablecoins that need to be resolved. And that is the legislators are trying to resolve it in the scope of the Clarity Act in order to allow stablecoin activity to begin. There is certainly a lot of posturing and conjecturing at this point from various financial institutions, traditional banks, payment system providers, clearing houses, and so forth about what they are going to do after the Clarity Act is passed. But right now it is just in waiting. But like I said earlier, I think that consumers and certainly institutions are going to be forced to use stable coins because the transmission is instantaneous as opposed to, let's say, a wire, which may take a couple days to clear, maybe an afternoon. It is cheap. They can be transmitted on one of the various layer one blockchains like Ethereum, like Solana, and so forth, BNB, for pennies, and it is securely transmitted. So, and then beyond the stable coins, tokenization is going to bring real world assets like real estate and bonds onto the blockchain. Okay. So let's get to the differences between some cryptocurrencies. Bitcoin, as I mentioned earlier, is primarily used as a store of value. Some have given it the moniker digital gold, but essentially that is what Bitcoin is. Bitcoin has a finite supply. It is not very easily transmitted as other cryptocurrencies in the sense that it is not as quick. The Bitcoin blockchain does not update as quickly as other blockchains do. And so most have looked at Bitcoin because of its finite nature, because of its level of security coming from the proof of work system, the mining system. Folks have looked at it as a store of value. It is now held by corporations the world over as a mechanism for preserving treasury value. Banks hold it for treasury value, as do endowments, foundations, sovereign wealth funds, and investment managers all around, whether investing on behalf of themselves or suggesting it to their clientele. They are all exposed to this in some way, shape, or form. On the other hand, from Bitcoin, altcoins actually do something. So altcoins are the payment mechanism for using an open source software. So the Ethereum network or the Solana network or the BNB network allows other applications to be built on that network. The way to pay for transactional activity, either on the blockchain directly or on those networks, is by paying in the native currency to the network, which is either Ethereum, or Solana, and so forth. The reason that these open source softwares are so valuable and why they hold so much promise is because they are able to digitally execute on contracts, agreements between two parties. So if a person were to have, let's say, a life insurance policy with a certain policy provider, there would need to be some evidence of death submitted. There would need to be some diligence done by the insurer. And then at some point, there would be transmission of the funds due under the contract. In theory, under a smart contract, you could immediately upload the death certificate and there would be instant settlement on that type of a contract. So it takes out a lot of, I would say, human involvement, certainly takes out a lot of time. And with that time, which is human time, it takes out a lot of cost as well. And so you can imagine that contracts that are easily settlable, not complex ones where there's going to be major disputes, but those that are easily settable, like an options contract, for instance. It is certainly much easier and better and safer to have that contract and its value reside on a blockchain and get settled on a blockchain between the parties. And so you have all sorts of asset transfers, and then you can imagine lending on those assets and leveraging those assets as well occurring on blockchain. And so you hear the words DeFi or decentralized finance. All of that is happening on the blockchain. Obviously, there are humans at the very ends of these transactions still, but the functionality of the transactions, the settlement of the transactions, the recording of the transactions are all handled digitally. And at the same time, they are handled on ledgers, let's call them, or on systems that have greater security than any security that exists for an insurance brokerage or an insurance underwriter or a bank, a traditional bank for that matter. And so you have an open source global computing platform and it generates cash flow, right? Because every time you want to transact or two parties want to transact on one of these platforms, there is a payment mechanism. It is small, certainly in comparison to what it costs in the traditional platforms to execute a transaction like this, but there's still cash flow generation. And so when it comes to altcoins and smart contracts, this boils down to a foot race in terms of who can lure the greatest amount of adoption by folks that are building all sorts of transactional programmatic systems for various types of asset and transactional settlement. Okay, so this slide is meant to give you an overview of the different types of assets, right? Let's look at the bottom row first, right? If I were to talk, a couple of 100 years ago about assets, I'd start to, over time, bucket assets into different silos, like the furthest to the left, precious metals, and then you've got maybe either commodities or critical infrastructure and services and so forth going to the right. And then you've got real financial assets that have no physical form at all. And that's the way you can think of crypto assets that are located on the top line. Not that they relate directly to those assets. So for instance, Monero is not based on copper and Zcash based on silver. No, there's just a bucket of crypto assets that are pure commodities, right? They're just stores of value. There are differences between Bitcoin, Zcash, Monero. It's outside the scope of this discussion, but they really don't have any transactional value. They are simply held for the value in which that is stored within them. The same way you would hold some gold or some silver or some copper. Who decided that those things are worth the value that they are given? The open market. You can say, yes, they do have some functionality, maybe in building or as inputs into certain industrial activities, or in the case of gold, for jewelry purposes. But we all know that the overall gold market is certainly not based on the jewelry value. It is based on the fact that it is a tremendous place to store value, and it is inflation resistant. And so it is an asset that is used at times where there is a flight to safety. And so it gains value from all of those attributes. Similarly, the digital form of that, Bitcoin, is the same. And so as we move towards the right, there is more functionality to each of the cryptocurrencies. I'll leave it up to you folks to kind of explore what they do, but they largely, everything to the right of the first block has functionality. They do focus on, I wouldn't say specific asset classes. Many of them are able to transact in multiple asset classes, what they're used for. So, for instance, Hyperliquid has been in the news recently because of perpetual futures. Hyperliquid was not designed for perpetual futures, particularly in mind, but nevertheless, that is where many perpetual future contracts have traded recently, and Hyperliquid as a network has been very busy recently because of that. This is just a screenshot of simply values so that you can appreciate what type of numbers we're talking about. The market cap is really important. Look, Bitcoin is at north of $1 trillion. The next closest is Ethereum at $200 billion. So we're talking about, assets that have an incredible amount of potential that are truly valued, very, very low at this point. We're talking, in terms of capital markets these days, we just had a 1.75, total enterprise value enterprise in SpaceX go public. Yes, granted, there is a lot to be gained from space and certainly from the communications business that exists inside of SpaceX, along with X, along with Grok, and so forth. But certainly, if Bitcoin becomes the store of value of choice versus gold in the future environment, a $1.25 trillion valuation for Bitcoin is just a sliver of what can be expected. Similarly, when it comes to Ethereum, if you go further down, number 7, Solana, the amount of transactional activity that is expected on these blockchains over time is really not represented in their values. And then finally, I just want to, to go back to ETFs for a second, just so there is full disclosure. When you buy a crypto ETF, you buy a stock effectively through your brokerage. There is a custodian that is authorized by the ETF to accumulate the underlying cryptocurrency. The benefits are obviously there's easy access, there's a bunch of regulatory regimes around it. There are tax benefits if you're a long-term holder and you get long-term capital gains tax treatment, but you don't own that cryptocurrency directly. And in earlier stages of the growth of the cryptocurrency sector, that has been a problem, because what if your custodian is not as diligent or insulated or threat proof as the custodian represents? I really think that we've passed that chapter in cryptocurrency history, and I don't think it'll be visited as acutely as it once was. But nevertheless, it's very important for me to go ahead and disclose that you don't actually own the crypto. You can own the crypto if you'd like. There are ways to do that. It is more cumbersome than just buying an ETF. But nevertheless, many investors now just opt for investing in the ETF. It's certainly much easier, and it has some other benefits as well. I'll go ahead and pause there for any questions.
All right, David, we have time for maybe 1, 2 questions. Someone wrote in, they're like, all this digitization, excuse me, is at some degree of jeopardy because of brilliant hackers. What protections are in place and will they hold?
So hacking has not been an issue at all. No major blockchain has been hacked ever. It has been anything that you've seen with respect to losses in cryptocurrency is entirely human error thus far. And I say that with total genuineness. The threat does come, though, from quantum computing. And there is a very large debate that rages about the speed of development of cryptocurrencies protections versus the speed of quantum computing's capabilities. Now, all that being said, if quantum computing is going to enable a breakage of blockchains, of public blockchains, you can bet that quantum computing is going to be able to break whatever security measures your bank has, because your bank security measures are centrally located. They are simply located on the bank's servers. The benefit of a decentralized ledger, it is not located in one place. It is located in every single validator in part in their capability to compute. So I recognize that the threat is out there, but all that being said, we have much bigger problems on our hands if quantum computing catches up and is able to break blockchains.
All right, David. Well, thank you so much. We greatly appreciate the presentation today. Everyone, we're speaking with David Towell, President of ProChain Capital. Thanks again, David.
Thank you. Have a great day.
You too. All right, everyone, a big thank you. You're watching Money Show's virtual event. Thanks for the great questions and for attending. Stick around. We have more great content coming your way for the rest of today and all day tomorrow. So be sure to hop back on tomorrow as well. Thanks a lot for being here. Share us with your friends and family too. We'll be right back with you.